I'm going to ask you a very simple question. How do you find great companies to invest in? There are thousands of companies all around the world. So how do you find the best one to put in your portfolio? Do you use a screener? Actually, this is a question that I'm frequently asked. How do I find companies to invest in? I don't use a screener, but there are multiple ways to find great companies. One of them is to look at products you're using and then look at the company making these products or services. This is what happened to me with Booking.com. I use Booking.com to travel whenever I'm booking hotels. I travel at least twice a year. So whenever I'm booking hotels, it's done on Booking.com. And I have been using this for about a decade. So I know the product very well. Let's look at the company. But that's not all. Because if you like a product, that doesn't mean that everyone else likes the same product. Maybe there's a competitor making the same product, better margins. You should invest in the competitor. Maybe you just like this product for some reason, but the other one is better. That's why the second step, whenever you're looking at companies, we'll talk about Booking.com in 1 minute. Just me guide you through this process of finding companies, because Booking.com is a great company. I'm going big on this. So how did I find it? So then you look at the competitors, and it's a quick analysis. It's going to take you maybe 1 day, 2 days. It's a quick analysis. Just try to understand the different businesses. For Booking.com, competitors or TripAdvisor, which I have in my portfolio, Expedia, Airbnb. Looking at these, why is Booking.com better? They have better margins. The revenues are growing as fast as compared to Airbnb, but Booking.com has higher returns on equity and it's approaching 100%. So what's happening there? You need to understand they are buying back a lot of shares, so they are generating a lot of cash flow. Booking.com also has a good returns on invested capital, better than the competitors. You try to estimate the intrinsic value based on all of that, looking at the balance sheet and everything else. And if that intrinsic value is below the market capitalization, maybe you should dig deeper into the company. Even if it is not below, it is around, maybe look deeper, because maybe you have missed something. That intrinsic value you calculated is a rough estimate, and that's not going to be the final one. You now go deeper into the company and look at everything else. This is what we're going to do today. Let's go deeper into Booking.com, Booking Holdings. It's called Booking Holdings because they have other businesses apart from Booking.com. For example, Kayak, Agoda, all of this is under the Booking Holding umbrella. But the most famous one, the one bringing them the most profits, the most revenues, is of course Booking.com. I'm sure you understand the business very well. You want to travel somewhere, you have to book hotels. You go there. Almost all hotels are listed there. You book. It's handled by Booking.com. You go to the hotel. You show them the confirmation number and you can stay in the hotel. So it's very simple, very straightforward for you to find hotels instead of you Googling about it. But they are trying to upsell you. You will see if you use it, they try to sell you cars to rent, airport transfer. They try to upsell you. But there's competitors in terms of that. But for the hotel business, they are well above the competitors, because Airbnb, this is a completely different business. It has been working for some years, but now I'm seeing issues that people prefer to go to hotels. You don't have to pay cleaning fees. Now that you have understood the business, what's the next step is to go through the annual reports to try to see how the business has been doing over the years. If you read the annual reports, the 10K forms, you're going to have more information. They will give you the risk and everything else. But I prefer to go and look into the numbers. So you look at the revenues and then the expenses of the company and everything else, every line, you need to understand what's happening. So if revenues are increasing, okay, why is it increasing? More people are booking. So they are going to give you another metric, how bookings are increasing and how much revenues they are making. And in the case of Booking Holdings, it's gross booking and room night books. So these are the metrics that they measure their success. And as you can see, there has been massive growth in 2022 compared to 2021. 58% growth in gross booking. So when people book this, and then this is going to be converted into revenues, you need to find the conversion rate. So at which rate, how much booking is actually being converted into revenues? Because maybe bookings are increasing, but revenues are not increasing. What matters is that the company is making money, not that they are making hotels money. Of course, they are making the hotels money too, but the company should also be making money. And one interesting thing to note about Booking Holdings and the industry in general is 2020, 2021 too. There have been the pandemic, travel was almost zero. So it's good to see how the company did in this year when people were not traveling. And in the case of Booking Holdings, they did actually pretty well compared to the competitors. So you already have the worst case scenario. I don't think in our lifetime we'll have another situation like this again, hopefully not. So you already have the worst case scenario. This will be important in the future to know when you're estimating future cash flows, what's going to happen in the worst case scenario. Can the company survive? Of course, 2020, 2021 were exceptional years. It's very hard for you to say that revenues grew by 50% because revenue was so low. So it's better to compare with 2018 and 2019. And in the case of Booking.com, you will see that revenues have been growing and even relative to 2018 and 2019. Now you start to think about the future. What's going to happen? Are people going to travel more? It's something that people want to do, especially younger people. They want to travel more. They want to discover the world more. So it is very likely that in the future, more people are going to be traveling and more people will require that they book hotels. So if you build a hotel, you would want it to be listed on Booking.com. Booking Holdings is going to be here. They have kind of a mode. Even though there's competition, they have a mode. They are the largest player. So the business is going to survive. They are going to generate more and more revenues over the long term. But revenues is not what's more important. What's important are profits. So how much of the revenues can be converted into net income, into profits? You look at that, you look at the expenses of the company. That's why I said margins are very important, because if a company has low margins, a fall in revenue means they're losing money. But if a company has high margins, a fall in revenue means they're making less money. So they're still profitable. And that's the case for Booking Holdings. What's more important than net income is, of course, free cash flow, owners' earnings. How much cash the company is actually generating and how much of this cash they can return to shareholders. Because this is where Booking Holdings is different compared to competitors and compared to the average and most companies in the United States, and I will even say around the world. They are a buyback cannibal. They have been buying back so many shares that the book value of the company is now negative. Usually there are two ways to calculate book value. Book value is the net worth of the company, the total assets minus the total liabilities. This is the simplest way to calculate book value, also called shareholders' equity, common equity. So how much of the company is actually owned by the shareholders. And here I'm talking about real assets, not future growth, real assets that exist right now. And you will see that Booking Holdings has a negative book value. So the liabilities exceed the assets. Usually you would say that this is a bad thing. Why are you going to invest in a company with more liabilities than assets? Because assets should be bigger than liabilities. Look at yourself personally. You don't want to have more debt than assets. But if you consider the other way that book value is calculated, you will understand why actually for Booking Holdings, it makes sense that it is negative. So the other way to look at book value, because in accounting, everything has to balance. That's why it's called a balance sheet. Things have to balance. So what you see on the income statement should balance on the balance sheet, should be the same. Another way to calculate the book value of a company is to see how much capital has been injected into the company. By how much capital has been injected, I mean how much money the company raised from private equity, how much money they raised when they went public. So that's the capital injected into the company. And from that, you add all the retained earnings. When a company is making profit, they are reinvesting the profit in the company. So this is retained earnings. So this should be equal to the book value of the company, because the profits eventually become assets. And if they take debt, then the earnings are no longer retained, because taking a liability is an expense. So this, in theory, should be the book value. But what happens if a company is buying back a lot of shares or is paying a lot of dividends? So you have to take the earnings away. In the case of Booking Holdings, they have been buying back a lot of shares. And this is called treasury stock. When the treasury stock exceeds the retained earnings plus the capital injected, of course, the book value will be negative. But that doesn't change the fact that liabilities exceed assets. But they can maintain this if the cash flows are so much that they don't have to worry about running out of cash in order to meet their abilities, because they are generating cash flow at such a high rate. And this is the case for Booking Holdings. They are a very efficient company, and cash flow and net income is different. So net income is what is being added to the retained earnings, but if the cash flow exceeds that over the long term, then they're actually able to buy more shares than the retained earnings, and they don't have to risk being bankrupt or defaulting on a debt or something like that. They are so efficient that they're able to do that. So to put it simply, what they are doing is that they are taking money from customers and bondholders, that is creditors, and giving it to shareholders. There are only a few companies that I know, AutoZone is another one, Apple very soon will be like this, that is able to do that. You can find the full analysis of Booking Holdings on my research platform. You'll have all my analysis there. You can see how actually I calculated the intrinsic value. But just to summarize it, now we can calculate the intrinsic value of Booking Holdings. So how do we do that? We try to estimate, okay, don't look at the current growth. Lower it. If the company is growing at 20%, let's lower it. Let's assume a bad case. Let's assume that we have a recession. What is the certain amount of cash that the company can generate in a year? You take that and you discount it at a proper rate. You add back the net debt of the company, because this is the amount of cash in theory that the company can return to you. And then you take a margin of safety, because probably you have made a mistake. And if the number you get is bigger than the market capitalization, then most probably it is a good company to invest in. So it's not important that the company is buying back shares. It's not important that they are paying dividends. It's about the way that the company is so efficient that they have such a high returns on invested capital. There's little capital required for the company to grow. In the case of Booking Holdings, what is the best use of capital is to return it to shareholders, and it is undervalued. That's why you invest in the company. You don't have to look at they are buying back shares or not. Of course, if they buy back shares, eventually this is going to reward you, the shareholder. But what's important is how efficient the company is. So it's two different things. Capital allocation is different and business operations is different. You're investing in the business. So you look at the business first and then you look at capital allocation. Booking Holdings is a company I'm investing in. I'm going to go big into this company. Another one is Stellantis. I would recommend you watch this video where I explain my reasoning behind investing in Stellantis. Have a nice day and goodbye.